index of DXY. And mind you, that rebound was coming off fairly predictable sort of lows. The DXY was approaching the historical lows recorded very early in 2009. So they were fairly predictable sort of rebound levels. But this is not a rebound that is long-term in nature. This is a rebound that's come off oversold levels, and massive short positions against the US dollar. You get a bit of a US dollar, and you get a bit of squeeze on short US dollar positions. Okay. And that rebound could continue for a number of months. Broadly, we're just breaking it out. For convenience, we're breaking it up into two halves, first half and second half, but it's not literally like that. So we've got to be flexible and non-dogmatic, but we could see a rebound that could take, for example, you could take the euro down to 145 against the dollar, 144, 140, which is around where we are.
And against yen? Against
the yen, it could go all the way back to 95, 96.
Okay. All right, and then second half, you know, timing flexible, we're back to short dollar Asia?
I think so. I think the broader the broader longer-term economic fundamentals for the US dollar remain largely gloomy. The debt, the deleveraging, the household balance sheet, the deficits the current account deficit is narrowing. It has narrowed very significantly, but it still remains in a deficit situation. And there's, of course, the massive treasury issuance that's going on to finance quantitative easing that will continue to overhang the US dollar. So, for example, we're likely to see the Aussie trade below 90. We are forecasting 85 cents for the Aussie against the US dollar by at the low point of the year, before a rebound back to parity, towards parity,
85
breaking higher.
85 will be what, about halftime, June-ish?
Probably Q1, end Q1, early Q2.
So that'd be a time to go in.
No, I think
for a rebound in AUD.
Absolutely. I think if you were reasonably optimistic, as we are, about emerging markets, you're reasonably optimistic about commodities, which is being consumed by the emerging markets, that would be an opportunity to get back into the Aussie again. 85 cents against US dollar would be a terrific opportunity to get back into into the Aussie, to break prior highs, go towards parity.
All right. Now, the other question that a lot of just about everybody's asking is there opportunity left in bricks and mortar in property in places like, let's say, Singapore, let's say, Hong Kong?
One of the problems where you have a global economy being driven largely by ultra-low interest rates in the U.S. and excessive monetary growth in the U.S. is that you have, and where you have currencies that are linked to the U.S. dollar to a larger or to a greater extent, so you can have divergences between property markets and asset markets around the world. You have seen the Australian property market barely pausing for breath, and it's taking off again because global monetary conditions are still hugely stimulative, notwithstanding the interest
But Aussie rates are going up, aren't they?
Yes, notwithstanding that. If you look at how the Australian economy has been performing, and when you have international flow still coming into Australia, that's likely to drive Australian property prices yet even higher. And we've seen in the case of Singapore, if you have ultra-low interest rates and you can borrow at around 2%, you can borrow on a mortgage, you can lock in a mortgage for 2-3 years at 2% or even less. And when you're getting a rental yields for freehold at about 3% and 5 or 6% for 99-year lease properties, it's enormously attractive for people to get in. And it's not even the mortgage rates. For a lot of Singaporeans, lots of Asians were cash rich.
It's the dominant factor, because you leave your money in the bank. What do they pay you? 0.5%?
It's not even a mortgage. It's about your cash rate. It's about your cash rate. When you're getting 0.5%, even 2.5% yield is hugely better than leaving your cash in a bank.
Okay, Talking Sense with Lim Se Boon, as always. Good to see you, sir. Come back soon.
Thank you.
Okay, we've been talking to Lim Se Boon from Standard Chartered Group. He's the chief investment strategist there. All right, coming right up, despite what you may have heard, our next guest says that commercial real estate is the place to put your money. Find out why when we come right back. Don't go away.
Left intercept the final bearing 222. 130.
Mr. Modern, a magazine of leading Asian male fashion. Asia 50 Mr. Modern ceremony. They are art elites. They are entertainment and sports stars. They are business leaders. They are social heroes. Asia 50 Mr. Modern Ceremony. Coming soon.
Hi, Vijay. I know you're her biggest fan. So tell Meena her pitch to relocate us to Bahrain was spot on. The figures are in. We've saved 60% on office rent alone compared to Indra's choice of golf location. I make that Meena 1, Indra 0. And my tax bill is in, a big fat 0. I make that me 1, you 0. Cheers. Sita Brahmachari, Project Director, Data Consultancy Services Limited, Bahrain.
Fact: the Gulf's lowest operating costs and taxes are in business-friendly Bahrain.
What is traffic? Just wheels and steel? Or people on different paths, sharing a road briefly? Everyone wants to get somewhere quick today. But how many know where they are going in life? For those who do know, we have a car. A car that reflects the qualities that set them apart. A car respected for its commitment to excellence. The new E-Class, engineered around you.
Go inside with CNBC Originals. Discover the secret behind the best-known product on Earth. Join the search for the world's greatest internet phenomenon. And in an amazing all-new look, CNBC's Peabody Award-winning team uncovers the unseen world of the planet's largest retail empire. It's anything but business as usual. CNBC Originals. Go inside. Have you tried Conan O'Brien?
I used to do a ton of Conan. You know, just one thing would lead to another, and I'd be up all night with it. But I'm better with it now.
Try Conan for yourself.
One night at a time.
This is CNBC.com News Now.
Kamoa Asiana shares are down after the South Korean conglomerate unveiled an aggressive restructuring plan, which includes layoffs, salary cuts, and raising $1.1 billion in asset sales. Japan Airlines stocks, on the other hand, are up more than 4% after a majority of its employees agreed to pension cuts, which would reduce its pension shortfall, a key prerequisite for a state bailout. The cold snap in the U.S., Europe, and Asia is heating up oil prices. NYMEX crude rose more than $2 to sell above $81 a barrel, its highest close in 15 months. Details of these stories more only on CNBC.com.
The credit surge in Asia has found its way into various asset classes, most notably real estate. But governments exiting their ultra-loose monetary policies could put a spanner in the works. For more, Peter Churchouse joins us, chairman of Portwood Capital up in Hong Kong. Our studio's there live. Peter, good to see you again. You know, for as long as I can remember, you've been pretty much Mr. Point Man in terms of property. We left off talking to Limsei Boon from Standard Chartered about prospects for property, and Luke, it's almost sort of a default play because you leave your money in the bank, and if you're lucky in places like Singapore, they'll pay you 0.5%. So, you know, if you can get a mortgage for below 2 and you get net rental yields of 2.5, 3, maybe even up to 4, it's a no-brainer. But the risk is, and we pointed this out seconds ago as we introduced you, as interest rates start to rise, your mortgage goes up as well.
Well, that's right, and I hate the word no-brainer because the no-brainer basically will end up beating your brain to death at some point. And there's only one way interest rates are going to go over the next couple of years, and we know that's going to be up. So I think one want to be a little bit cautious about that at this point. But having said that, though, you know, the residential recovery story in Asia is pretty well known. It's pretty much factored into markets over the last few months. You've seen big recoveries in Singapore, Hong Kong, China, Korea. But I think the commercial real estate market is perhaps where we might be looking for opportunities over the course of the next 6 or 9 months.
Diametrically opposed to what's going on in the U.S., where there's huge risk hanging over commercial real estate. We'll talk about that in just a bit. I just want to get some comparisons, some metrics out of the way, Peter. In Hong Kong, where you are, what are some of the stats like if you're, let's say, into an investment property? What are mortgages going for? What are net yields like if you're renting it out?
Well, that's exactly the same as, very similar to Singapore. If you take a mortgage in Hong Kong based on the local interbank rate, which you can get, it's around about 1%. And if you take it based on the prime rate, it's around about 2.5%. So you've got well under 2.5% as the possible mortgages. And again, as you say, for middle-ranking properties, even in Hong Kong, you're expecting yields of about 3.5% to 4.5%. Depending on location and quality of property. So there is definitely a positive carry right now.
Indeed, and a lot better than leaving your money in the bank. The risk, though, not just with interest rates rising and making your mortgage more expensive, but I mean, in both markets, Hong Kong and Singapore, both you and I know it's never been about yield. It's been about capital appreciation. They've been largely speculative and punters markets. So the thing is, we've seen tears, prices on a tear in both places. Upside from here, or is there a risk that people who bought recently could get burned again?
Well, I think in the short term, if the markets were left unfettered and the government stayed away from it, I think you could see in both markets an average house price or flat price go up 20–25% in the next 12 months. However, central banks and governments are very conscious of the fact that affordability is getting worse, and excessive lending into the real estate market could lead problems for the banks further down the track. So you're seeing both in Singapore, Hong Kong, China, and also increasingly in Korea that governments are moving to act to try and slow down the pressures that we've seen in the property markets over the last few months. So I think we're going to see government intervention, which will in effect reduce the level of price increase going forward.
Okay, and therefore the risk as well understood. Let's get on to commercial real estate. Why are you so positive about commercial real estate out here in Asia?
Well, I think what's happened is residential markets have picked up very strongly, as we all know, but office rents are still down 40 or 50% from their highs in 2008. As the economy recovers and vacancy rates come down, I expect that office rents will start to pick up again, and you might easily start to see a bit more good news coming into the media about the commercial property markets, and that I think could do well for commercial property prices and also for stocks that are involved in the commercial property market.
Interesting stuff here. In terms of, when you break down in terms of markets, where are prospects better for commercial real estate, Peter?
I think in the short term, Hong Kong looks pretty good. Vacancy rates are still quite low. There's not a lot of supply coming onto the market. Singapore still has a bit of supply coming on, so there's a bit of an overhang there. But I think Singapore will follow Hong Kong all the same. Markets such as Shanghai will probably follow a bit later than that. And Beijing, I think, will be a little bit further down the track because there is a massive oversupply in that market. But the first market, I think, to see recovery in rents will probably be Hong Kong amongst the majors here in this part of Asia.
Okay, a pleasure. We've been talking to Peter Churchouse, chairman of Portwood Capital, live from our studios up in Hong Kong. And talking about Shanghai, Cheng Lei standing by up that side for the market, 40 minutes away from kicking off Tuesday trade. How are we shaping up, Lei?
Hey there, Martin. We're looking at the first batch of preliminary 2009 earnings. Plus, we've got sales numbers out of 3 automakers. I'll break down